Hi, Matt.
Hi, Lee. How's it going?
Good. Okay, everybody. This is Mat Sorensen. He's out of California. He and his partner, Mark Kohler, they do the Refresh Your Wealth podcast on the internet. And Matt has written a book, the IRA Handbook, Self-Directed IRA Handbook, and it's very, very good. If you want to study how to do a self-directed, I highly suggest you get that before you actually start doing it. And Matt's agreed to speak with us for a little bit today, and nothing here is legal, accounting, or any other kind of professional advice. It's just for your entertainment. Yeah, run it by your lawyers and stuff, you'll like it. Other than that, go ahead and take it away, Matt. Thank you.
Okay. All right. Well, thanks for having me. So I just want to give a quick breakdown on how self-directed IRAs work. And a lot of people use them in the real estate industry, so I want to make sure you understand how they can work and how you can use them either on your own real estate deals, other people's money, or how they could possibly, you could build your own retirement account using a self-directed IRA. So as Lee said, I wrote a book called the Self-Directed IRA Handbook. It's the #1 book used by people in the self-directed IRA industry. It sold 20,000 copies. It's an Amazon bestseller. #1 hot new release when it came out. It really is the book on self-directed IRAs. So it's $20. You can find it on Amazon. But what I think is really important to understand about a self-directed IRA is I think a lot of people think of retirement accounts and they think, oh, mutual funds or stocks. A lot of people don't realize that IRAs and 401ks can actually be invested into real estate. And the reason this is a big deal is there's really 25 reasons. There's 25 trillion reasons why this is a big deal. There's $25 trillion in retirement accounts in the United States. And, you know, some people, you may be sitting there and you might have your own little sliver of that 25 trillion in your own retirement account. You may be thinking, I don't have any money in a retirement account. Why should I care? Well, everyone else does. There's 25 trillion out there, and that money can be used on real estate deals you may otherwise be involved in. That money could be funding a real estate deal you may be doing. So it's a really powerful tool. It's really taken off over the last 10 years. Very popular now amongst people investing in real estate is how can I use a retirement account? So there's really 3 things you really got to know if you want to use a retirement account to invest in real estate. The first thing is, how do you get a self-directed IRA? So you may have money like at a prior employer 401k, or maybe you've got, or someone you know has an IRA at TD Ameritrade, right? And they're buying stocks or mutual funds. So, but how do I use that money in a real estate deal? Well, the first thing you have to do is you have to find a custodian who allows retirement plan dollars to be invested into real estate. And there's probably 25 to 30 of these self-directed IRA custodians out there. And it's, let's say your money's at TD Ameritrade, you have a traditional IRA there. Simple, all you gotta do is say, TD Ameritrade, I don't want to use you anymore. Send my money to ABC Trust Company, who's gonna be my new IRA custodian, and they self-direct retirement accounts. So they'll let me invest into real estate. So now my IRA can own a rental property. It could own a property that's being fixed and flipped. My IRA doesn't need to own like a REIT or a fund or anything. It'll be on title to the actual real estate. Or it could own an LLC 100%, and that LLC owns the real estate. So the first thing, though, is you have to have a custodian who allows you to self-direct. So, for example, if your money is at Fidelity, or someone you're wanting to work with has money at Fidelity or at Merrill Lynch, and you call there and you say, hey, I want to use my retirement account to invest in real estate, they're going to say you can't do that. Or they're going to say, okay, well, you can put it into a real estate fund. But what they're saying, the reason they don't let you invest in real estate isn't a legal rule or a tax rule. The reason you can't invest into real estate is simply because they don't let you do it. It's their internal rule. It's too much work for them. It's much easier to let you buy financial products. They happen to sell financial products. They make commissions when you buy stocks or bonds with an account there. So that's what they want you to buy. They put that on the menu. They don't want you to buy real estate. They don't make money. It's a different model and business of how to do it. So they're going to push you off and say you've got to go somewhere else. So fine, you close your account there, roll over the money to the custodian that allows you to self-direct. So that's step one, is you need to have a self-directed account with a self-directed IRA custodian. The second thing is retirement accounts can only be used for investment purposes. So you can't use the retirement account. You cannot use the retirement account to like buy your own home. So I can't use my IRA to go buy a home for Mat Sorensen. That wouldn't work. But I could use my IRA to go buy a rental property, or my 401k could own a rental property like that. My 401k actually owns an LLC that owns a rental property. So that's totally fine. So whatever real estate you're buying, it just must be for investment purposes. It can't be for personal use or personal benefit, nor can it be for your spouse's use or your parents or kids. Those people are all restricted. It needs to be held simply for investment purposes. The third thing to know, so the second thing is it must be held for investment purposes. The third thing to know is you can't personally benefit from the investment. So you shouldn't be making any investment with the intent to personally make money. So sometimes people will say, well, I'm a real estate agent, so I'll use my IRA to go buy a property, and then I'll make a commission on it. And because I'll be the buyer's agent representing my own IRA buying real estate. That's what's called a prohibited transaction. You're benefiting from the retirement account's investment, so you can't do that. So there's kind of these rules are called prohibited transaction rules. It's 3 chapters or 4 chapters in my book that goes over these rules, what you can and can't do. But the basic point of them is they're designed so that you personally, your spouse, your kids, your parents, there's these people who are called disqualified. Those people aren't designed to make money off your retirement account. Your retirement account is simply supposed to go invest and make its own money, get rental income, let's say your IRA owns a real estate, a rental property. The IRA gets the rental income. The IRA pays the expenses. When the property sells for a profit, the money goes into the IRA. Now remember, retirement accounts, one of the main benefits of retirement accounts is that you don't pay taxes, you make money. So if you have what's called a traditional retirement account, let's say I buy a property for $100,000 with my IRA, and I sell it for $150,000. If I did that in my IRA, I don't pay any tax on that $50,000 gain because retirement accounts don't pay tax on investment income. If I took that same $100,000 and personally bought a property and sold it for $150,000, I'd pay tax personally on the $50,000 gain. So that's a reason a lot of people like to use retirement accounts is you don't pay any taxes on the profits you make. Now, traditional retirement accounts, you pay tax when you pull the money out. There are accounts called Roth IRA accounts where you pay no tax. There's no tax as you're making money and no tax on the way out. So that's a quick thumbnail. I want to do some Q&A though, see what questions you had or Lee, what you have. That's a quick summary on how a self-directed IRA works. 1, you need a self-directed IRA custodian. 2, you need to make investments with it. You're not using the IRA for personal benefit. And 3, you got to avoid prohibited transactions. Remember, you're not supposed to make money off it, or your kids or your spouse or parents. It's designed again to be simply for investment purposes. But for a lot of people, and I speak a lot to real estate groups, I'll ask a room typically, how many of you have retirement accounts? And maybe half the room raises their hands. How many of you know a good mutual fund to buy with your retirement account? And most people are like, I have no idea. How many of you own a mutual fund? Everybody that has a retirement account owns a mutual fund. And so they're investing in stuff, they don't even want it. They don't even understand what it is. They can't even tell you a good mutual fund investment, but they do know a good real estate deal. And so I'm trying to do is people that have expertise in an industry, whether it's real estate investing or private equity or venture capital or precious metals or whatever your thing is that you have expertise, is learn how to use your retirement account to invest in what you know. You're going to have a much better competitive advantage. And so that's one kind of plug of why you should use self-directed accounts. The other is, remember, there's $25 trillion in it. If you're out there talking to people to invest in your real estate deal, like you have a deal you need to get funded, it's much more likely the people you know will have money in a retirement account to invest in your deal than they'll have money in a personal savings account. The concentration of wealth right now in America is mostly in retirement accounts. Talk to anyone, any baby boomer, where they've got investable cash right now in their life. They might have $10,000 in a savings account somewhere, but most of them aren't going to have 100,000 plus to invest in anything, and maybe most don't have tens of thousands. But if you look, people that have an old 401k from a prior employer, they could put to an IRA, or they have an IRA right now, they might have tens, hundreds of thousands in there that they could invest into a real estate deal. So it's understanding how those people's money could be used to maybe be a private lender on your deal, where they act as the bank and they get interest income back to their retirement account, or they can partner in on an LLC on a real estate deal with you. So there's a lot of options on how it can be used. All right, so that's the quick outline. I want to see what questions any of you guys had, or Lee, what you have in terms of self-directed IRAs or how they can be used in real estate.
I got a question. Don't you have to get like a non-recourse loan or something like that? Because you can't, if I've got a self-directed IRA, my personal finances can't back up what I'm purchasing, correct? Or
correct.
Could you explain that? I know there's something to it. I don't know the specifics.
Yeah, so there is a restriction that a retirement account can go out and get a loan to buy. Let's say you want to buy a rental property with your IRA. A retirement account can't guarantee the loan, nor can you personally guarantee your retirement account's loan. So what you're left with is you have to get what's called a non-recourse loan. And a non-recourse loan is essentially a loan where the bank lends on the property, and in the event of foreclosure, they agree to simply foreclose and take the property back. They're not going to go after the IRA for any balance due. They're not going to go after the IRA owner. So it's considered non-recourse in that regard, in that the only recourse they do have is against the property they lent money on. Now, because of that, banks are going to require more money down. So there's a number of banks that specialize in non-recourse loans to retirement accounts that buy real estate. There's, North American Savings Bank is one. They have a website called IRAlending.com that has all their loan products for IRAs buying real estate or retirement accounts. Another one is First Western Federal Savings Bank. Their website's IRAlending.com that also has their loan products and information. But you're going to typically see 30 to 40% down. So the IRA's got to have enough cash to at least put 30 to 40% down. Now, a lot of people who use retirement accounts don't even get non-recourse loans. They'll just buy the property outright with cash. Although you can get a loan, again, it just has to be non-recourse. Okay, any other questions?
Yeah, so is there a limit on how much you can take out of that for your IRA? How
much you can take out of your IRA?
Yeah, is there like a dollar amount or a percentage that you can take out, or can you do it all? Just out of curiosity.
So do you mean take out and like take the, like if you're making money on the IRA, take out to live off of, or do you mean take out to then put into a real estate deal?
To invest, to put into a real estate deal.
So there are some restrictions. It really just depends on what type of retirement account you already have. So if you have a 401k, let's say, a lot of people that do a self-directed IRA have a 401k with an employer they used to work for, let's say. Those accounts you can move over 100%. You can move over everything to a self-directed IRA. If you have an IRA already with a broker-dealer, for example, like Fidelity or TD Ameritrade or Merrill Lynch, you can always move that. 100% of that account could get moved to a self-directed IRA. The one place where people get stuck, though, and they cannot move money into a self-directed IRA to buy real estate or invest in an LLC or lend money to someone else on a real estate deal, the one place people get stuck is if they have a 401k at a company where they still work. And the reason for that is a lot of the company 401k plans or pension plans say as long as you still work here and you're not at retirement plan age of 59 and a half, you have to keep your money in our company retirement plan. So if we use Fidelity or Vanguard or whoever we use, you're stuck using them. So that's a scenario where your money can get stuck.
Okay.
Is, again, you're still working there and you're not at retirement plan age. But every other scenario, you can really move 100% of the money to a self-directed account.
What about a Roth IRA?
Same thing. So if you have a Roth IRA already, you'll always be able to move that to a self-directed Roth IRA. You can move the whole thing.
Okay.
I've got another question. I've got a self-directed solo 401k, and what are the differences or advantages, maybe the differences between a solo 401k and a self-directed IRA?
Okay. All right, I love it. Okay, I was going to get into this. I don't know that we have enough time, but a solo 401k is awesome because, so let me say this. Everyone can have an IRA, okay? IRAs are individual retirement accounts. If you're an individual, you've qualified to have an IRA. There's something called a solo 401k, though, that's used quite a bit by people who self-direct their retirement account. However, a solo 401k is only available if you're self-employed and you have no other employees in your business other than you and a spouse or maybe your kids. So for those people who are self-employed without any other employees, a solo 401k is a great fit. What a solo 401k is, it's essentially a 401k with the most aggressive rules that allow you to put as much money in as possible, because the 401k, after all, is only for you. So why not make it as generous as possible? You're such a good employee in your own business. And that solo 401k, for example, you could put up to $56,000 a year now into a solo 401k. So it allows you to contribute a lot more money in each year than you can with an IRA. A lot of people who do a self-directed IRA, most of them are rolling over money. They already have got money in an IRA, or they've got a prior employer 401k, and so they just roll over a big chunk that they already have to a self-directed IRA, and that's a lot easier. Because if you start a brand new IRA and you have no retirement plan money, you can only put in $5,500 a year. So it takes a while to put enough money into an IRA until you can do a real estate deal. So again, if you have rollover money, you already have a bunch of money in a retirement account, let's say a Roth IRA you already have, or you got a prior employer 401k somewhere, those can get rolled over to self-directed IRAs pretty easily. And then many times people have enough money to actually do a real estate deal. Solo 401k is great, though, if you're self-employed and you don't have any money in a retirement account yet, or you're trying to put more money in. And so for those people, you can put, again, up to $56,000 a year, depending on your income, into a solo 401k. And there's some other differences on a solo 401k. For example, you don't have to have a custodian for a solo 401k. You can self-trustee it, which means you can be the trustee and sign off on everything. You don't have to have a retirement custodian company. We set up solo 401ks in our office like that. So that's an option, solo 401k, only if you're self-employed, though, with no other employees.
I have a question.
Yes.
So on the solo 401k, self-employed, I assume that means it's got to be your only source of income. You can't set that up if you're a sole employee of an LLC or S corp of your own, can you?
No, you could. You could. If you have a LLC or an S corporation and you're the only employee in it, that works. That'll qualify. You could do a solo K in that business.
Okay.
And we'll have clients too that have a day job somewhere and they've got a W-2. They may even have a 401k at that job, but then they have a business on the side that they also do a solo K in.
Okay.
What if you own another company where you have employees?
Then you have, there's called something called a control group that has to be analyzed. And essentially, in order to get to a solo K in the other business where you don't have employees, you have to have an ownership difference of 20% between the company where you do have employees, and it has to be a separate line of business. So, for example, I have let's take a dentist client. Okay, I have a dentist that's in a partnership with a few other dentists. 3 of them, they each own a third dental practice. They have a bunch of employees there. That dentist, though, has his own S corporation where he does fix and flip real estate deals on the side. He can set up a solo 401k in that S corporation business because there's an ownership difference between those two companies, and it's a separate line of business than the dental company. But if it's all you that owns both those companies, there's no way it works. Or you and a spouse, or it won't work.
So I found that contract on the internet for getting like foreclosures, pre-foreclosures under contract. So
Okay.
is that as valid, or would you need like could you use that? Like they say use that, but would you be more cautious and like use one from a lawyer or something, or like, because they're saying it's okay to use, but then I'm just like, at least like a PDF, so from some person on the internet. They said they did a lot of houses with this contract though.
You're asking a contract question. It's hard to say until I read the contract, you know what I mean? It's like, does this food taste good? I don't know until I taste it. I don't know. It's hard to say until you have to read the contract and figure out what you're trying to do. Sorry.
That was a good answer.
The new tax law on the 80% for flow-through
Yeah.
entities, would fix and flip be considered a service entity? Or is it investment?
Probably not. That's a good question, but probably not. You'd probably want to fashion yourself into construction services and stuff because they didn't get grouped into that. So I don't know that we've seen anything 100% on that, but I'd say probably not,
Thank you.
which is good.
Let's say you have a bigger deal where you need to put 50% of the money from self-directed IRA, also the 401k, and then the remaining is coming from your savings account. I'm
Yeah.
assuming that is not allowed, right?
It's possible. It's a little tricky on how you do that, but it's possible. This is chapter 14 in my book, by the way, on how to do this. It takes an entire chapter. So, general rule is don't do it. And I say that I wrote a whole chapter about it because you can do it. You have to fit really neatly into to the structure. So what we recommend if someone's going to do that is we set up a brand new LLC. The initial owners of that LLC are the retirement account and then you individually. And we break up the ownership in that LLC based on the dollars you put in from the retirement account and the dollars you put in personally. So if your retirement account puts in $60,000 and you personally put in $40,000, we're going to break up the ownership 60% to the retirement account, 40% to you personally. So, but that's possible. It's a partnership LLC. You'll have to do a partnership tax return. But then the LLC can receive the income, pay the common expenses on the property, and then split up the profits between you personally, where you will get taxed on any income made, and then over to your retirement account where you will be taxed on income being made. So, but that is possible. You just have to be tricky on how you structure it. And the keys are that you go into the investment at the same time with your personal fund and retirement plan funds. You use an LLC where the company ownership can be broken down cleanly, and then you have a bank account for the company that can receive joint income and pay joint expenses on the investment.
In the similar lines, you're putting 50% of the funds from your one of these IRA or
Okay.
401k. The remaining is owner financed. Can you do it?
Well, you could do it, but the retirement account would own the deal 100%. Because if the seller's financing it, that means the retirement account is putting all the money into the deal, so it'd get all the ownership. And that owner financing would have to be non-recourse. You couldn't guarantee the debt. I mean, they could have a lien on the property to make sure it's repaid, but it'd have to be non-recourse on the seller financing.
So it
But that's
cannot
definitely
be-
possible.
It cannot be on the personal, it has to be non-recourse.
Correct, yep.
And it could be a combination of all these three, right? That's another scenario where you're putting some money from your savings, some money from
Yep.
SDIRA, and then owner financing. It is possible. It has to be non-recourse and has to
Yep.
be done carefully.
Yep, exactly right. And the ownership, again, would be broken down between you personally for the personal cash you put in versus your retirement account for the retirement plan cash. If it was 50-50, then it'd be 50% personal ownership, 50% retirement account. And then the seller financing is simply non-recourse. There could be a lien on the property, but you're not guaranteeing it anywhere.
you're putting your personal money, so you're probably, usually, the financing, they would expect you to guarantee.
Yeah, you wouldn't be able to though.
Everybody else in here probably knows the answer to this, but like, I just got on 1099, so like, how do you do the taxes so you don't get like bit at the end of the year?
A 1099?
Yeah.
So on your personal return, which is Form 1040, you put that onto Schedule C, something called Schedule C, where you throw the 1099, and that's basically your self-employment income. And then you'll want to make sure that you track any expenses you have against that income, mileage or, meals and entertainment, office supplies, marketing expenses, all that is where you claim expenses against that income. It's called Schedule C.
Is it just like you write it on a pad or something, or like, I don't know. How do
No, you have to have actual receipts
Is it like
for the IRS.
Oh, yes, is each receipt like?
Yeah. Put it in.
You're supposed to have a receipt, but you at least have like your bank account records of that money being spent, and you can categorize what it was for. That usually enough to be able to file your tax return. If you're audited, you may have to hunt down a receipt though.
Do you answer questions on 1031 exchanges?
Sure.
I put $90,000 down on a property that was $250,000.
Okay.
When I go to sell it, do I get to take my $90,000 and pay myself back? Or does all the gains, no matter where it, okay, so I don't get it back?
I can already, the whole thing, if you're going to want to do a 1031, the whole proceeds when you sell it,
Right.
the profits plus the money you put in has to go into the new property. If you take money out, you can, but the first money you take out is the taxable money.
Okay.
They don't let you do it the way you want it to, which is
I
you
figured
take
not,
out
but
is
I
money you
thought
put
I'd
in,
ask.
not be taxable. Yeah.
Logically, it doesn't make much sense for us, but that's how the rules are written. The one workaround you might have is go refinance it, take that 100K, 200K, whatever it is, and then go do the selling. That way, whatever that you refinance, cash out, that you can keep without paying.
That's actually a very good idea. That's a good workaround idea if you're trying to get cash out, actually, is repurchase the replacement property and strip out equity. That can get you cash back.
Okay, do I have to separate the renovation costs as opposed to structures I built, which are capital improvements? Do I have to keep those two separated?
Yes.
Okay.
But the structural improvements may be considered the same as renovations. It just, certain things get categorized,
Well,
So
it's like I had 3 houses on the property that were 2 of them very dilapidated. I fixed those up and rented them, but I also built a 7-space RV park there was nothing there. So it's really clear, like one is capital improvements, the other is renovation costs.
they're probably both capital improvements, but I'd check with your accountant.
Okay.
They both capital improvements to me.
Okay. Sounds
Yeah.
good. Thank you for your help.
Sure, yeah.
Well,
Okay, what else you guys got?
you got time for more? Now, let us
Oh,
know
yeah.
when you gotta go.
Especially any self-directed IRA questions.
Okay.
No, anybody's got one other question? I got time for one more.
Is there a way to take and it's a complicated one, but if you have a self-directed IRA, $500,000 sitting there, and then because of all these limitations or restrictions that you have of non-recourse or clear separation and a lot of other restrictions, how about you lend it to somebody else? And then again, that person lends it back to your company or whatever. So I know it's not, there's no clear direction anywhere. Is that something would be flagged, or do you think is it okay to do that way?
It's not okay. Yeah, that doesn't work. So, and I think that that's, you know, that's like why the question's asked, because that's like on the edge, you know. So that they call that a step transaction. So this is chapter 9 of my book. It goes into this a little bit, but essentially what the IRS, how they look at that is if you loan money to one person and that person's supposed to then, you know, your IRA loans them money and then their IRA loans you money, they just consider that as if your IRA loaned yourself money. Anything you do where your IRA loans someone money or makes an investment and then they're supposed to do something else after to you personally is automatically prohibited. So I run across that probably once every other month where someone's done that and someone said it was okay. And it's just not, it's pretty clear it violates the rules. So it's kind of a smart way that you can look at the rules technically and say, I solved the problem, you know, I got around it. But the IRS has a doctrine called step transactions where they just collapse the person in the middle and they just look at it as if your retirement account loaned yourself money.
So what's our workaround for this situation?
Yeah.
No, I mean, it's a real situation, that's why I'm asking.
Yeah, there's pretty much not a way, there's no viable way that you can use your own retirement account and end up with money personally.
Yeah.
There's just not a legitimate way to do it. No matter how creative you get, it just will never work.
Huh?
Well, thank you very much, Matt.
Thank you guys. Thanks, Lee.
Bye.
So how do we?
Here.
I'm gonna buy your
Yeah.
book.
Oh yeah, you can go Amazon. You can buy the book there, and then you can also go to my website SDIRAhandbook.com. I have a blog there, and I have something called the free Self-Directed Investor Toolkit, which you can download. It has all my videos. They're basically meant for people new to the area to understand how they can invest. So you can check that out. It's free access.
Thank you.
That's it. Thank you guys, and thanks for asking.
Thank you very much.
Thank you,
All
Matt.
right, take care.
Bye-bye.
Bye.
Oh, that makes sense.
I've got a few notes. I've actually done some stuff with Matt. I had some ideas of what I wanted to do for the next 3 years, and I needed somebody that knew real estate, knew business, and I could run it by him. He was good with all but one thing, and that was pretty good, and I'll tell you that in a second. I got his thing on Kindle because I love Kindle. Every time my wife goes to the restroom or something, we're in the restaurant, and she goes to the restroom, I can read another paragraph or two. And it took me about 4 months. Mitt Romney, the president candidate, has between $25 and $100 million in his retirement account. And he did it through some of the strategies that it talks about in the book. So the reason it took me 4 months to get to the book is because I needed to figure out how I could do it and leverage it. You guys that are going to wholesale, read the book and figure out how you can do it, because options, that's how I figured out I can do it and leverage my IRA extremely and increase its value. Now, I won't be able to do it every day. Maybe once a year I'll find the right deal come along and I'll be able to do it. But if you're wholesaling, you can probably find deals quite a bit. And so if you get his book and then you got questions, call him up. He gives you free counseling for like 15 minutes, but he won't give you legal advice under the free counseling. And so I hired him for an hour to go through my ideas and everything. And let's say that you bought a rental, one of the rules, and this is what I figured out how I can get around it, really get around it, not just like he was. If you've got a rental, you cannot go in and fix the toilet yourself.
Right.
You have to hire everything out, and the IRA has to pay the rental has to pay back the IRA. Money cannot flow anywhere else but back and forth between the IRA. And so...
And you can't use sweat equity, that's what you're getting at.
Right, you cannot use sweat equity. So, and these rules are real important to know, and that's why I highly suggest you buy the book. It's because if you read the book, like one chapter I wasn't even interested in because it was tell you how to set up an LLC to do it in, and I didn't need that for what I was planning on doing. Read the chapters that you are, because let's say you work yourself 5 or 10 years from now, you got $500,000, $1 million in your IRA, and let's say it's a Roth IRA. If you break the rules and you get caught, the year that it happens that you broke the rule, that IRA will no longer be an IRA and all taxes will be due that year. So if you had $1 million, you'd have taxes, income tax due on that IRA in that 1 year. That's why you got to make sure you know the rules. Because if you break it, if you get sued personally and money's in your IRA, they cannot go through you and get to your IRA unless they break the IRA up. And that's what the lawyer's going to do. If you're being sued personally, he's going to want to see the transactions that happened in that IRA, and he'll try to find something that was illegal. Now, if you've done it all legally, he can never get to your IRA because that's the rules. So it's kind of a good way to protect your assets is have them in the IRA that you're building wealth up investment-wise. Now, if the IRA owns a property and that property gets sued, then it can go into the IRA and get money out because it's part of the IRA being sued. But going through you, it can't be sued. So it's like an LLC. It protects your assets. It's another way of protection. Let's see. Know your rules. IRA, self-directed IRAs they have higher fees, and so I've checked 4 of them, and they're all pretty high. But if you're making exponential your money on your investment, then it's well worth it. And the way I would do it was with options, because I could really leverage it that way. And that's all I have. About a year and a half ago, I pulled up 15 different podcasts on the internet because I've always been into taxes. And for probably 25 years, I was not going to pay taxes 1 year because I read this book and it says taxes were illegal, and I think the book was right. But I told my sister, and she said, "You're going to end up in jail from time to time." And this author had been in jail from time to time. She said, "If you just learn the rules to taxes, you'll win the game." And I thought about it all that year, and I said, "I'll learn the rules." And I have saved so much money over the years. Julie's known me ever since my boys were little. The oldest one just turned 18 this last year. All during that time, from about 5 years old on, I would hire them. And there's a little rule that people don't know about. You can hire your kids and not pay Social Security on them. And they don't make enough that they don't have to pay income tax. And I knew that rule, so I took full advantage of it all during their growing up. They never paid Social Security. And when they turned 18, sorry, that's it, you know. I would hire them, but I would have to pay income tax and Social Security because now they're grown-ups, you know. So know the rules to IRA, to the tax code, and you can really save a lot of money. Okay, you all can quote me cool.